Yesterday, it was noted that the physical bid was overriding every macro suppressor simultaneously. Today, Trump flew to Beijing, met with Xi Jinping, and both leaders agreed that the Strait of Hormuz must remain open for the free flow of energy. Silver dropped from $90 to $87. The COMEX registered vault remains at 80 million ounces, exactly where it was yesterday. The vault did not move to Beijing. It does not respond to press conferences. It does not follow White House readouts. It simply holds 80 million ounces of real deliverable silver, while paper traders react to diplomatic headlines. Every single time this year, when such diplomatic language appears, the paper price dips while the physical pool continues to drain. Today follows that same pattern. The Trump summit deal versus what the paper market interprets it to mean presents three scenarios for the next 15 days leading into May 29th. Every PSLV holder, every SLV holder, every physical stacker, and every AGQ trader needs to consider this framework before that date. The headline reads that Trump and Xi agreed the Strait of Hormuz must remain open. The actual substance, confirmed by multiple sources, shows that after the summit, there was no sign that China would increase pressure on Iran. China's stance remained consistent and clear, diplomatic language for no change. Secretary of State Rubio stated before the summit that the U.S. aimed to persuade China to act more proactively. Persuade indicates the action had not yet occurred. After the summit, no evidence confirmed that persuasion succeeded. Iran's foreign minister met China's foreign minister the day before the summit and accused the U.S. of dishonesty. Iran also issued a legal reframing of the Strait of Hormuz, claiming expanded jurisdictional authority. Iran had already rejected the 14-point U.S. proposal as totally unacceptable. In sum, Trump and Xi expressed goodwill about Hormuz. China made no new commitment, and Iran claimed expanded authority. The physical blockade continues. The paper market reacts to the headline. The physical reality did not change. 80 million ounces of registered vault silver remains unchanged. Before the summit, reports indicated the U.S. and Iran were edging toward a deal framework after Trump halted Hormuz operations. Iran was reviewing the U.S. proposal through mediator Pakistan. One official noted progress toward determining a framework, but nothing was finalized. The sequence of events follows. May 5th, edging toward a framework. May 9th, Iran rejects the 14-point proposal. Trump calls it totally unacceptable. May 13th, Trump flies to Beijing and meets Xi, and they agree on Hormuz language. The same day, Iran claims expanded Hormuz jurisdiction. May 8th, confirmed military contact. U.S. and Iranian forces exchanged fire in Hormuz. This is not a peace deal getting closer. It is a public negotiation stall amid continued military contact. The paper market prices the summit. The physical market prices reality. 80 million ounces of registered silver sits between those two forces and remains unmoved. The COMEX data shows that today's dip is the most significant data point in the May 29th setup. The COMEX registered pool is 80 million ounces, confirmed by all sources. Paper leverage is 6.5 times. Every ounce of deliverable silver has 6.5 claims outstanding against it. The COMEX stress index stands at 52 out of 100. The all-time high reached 88. We are already more than halfway to maximum stress. Coverage ratio is 15.3%, right at the stress threshold. The current status is labeled tight. May 29th is first notice day, 15 days from today, confirmed on the CME Group futures calendar. Physical deliveries for May 26 have already been executed this month, totaling 26.7 million ounces. That is more delivery activity in the first 14 days of May than all of April produced. March 26 saw 46.19 million ounces delivered. The physical delivery machine continues even with 3.1 million ounces flowing into the registered pool over the past 30 days. Silver still ran to $90.2 this week. The physical bid absorbs new supply as it arrives. Weekly silver closes confirm the structural trend. 2 weeks ago, 75.35. Last week, 80.35. This week's close reached 87.52. 3 consecutive weekly closes, each higher than the last. Today's intraday dip to 87.14 occurs within a rising weekly structure. Paper traders reacting to a summit headline are selling into a confirmed uptrend. Silver dropped $3 today. Scenario 1. Diplomacy remains stuck. No new deal by May 21st. Iran rejected the U.S. proposal and is claiming expanded Hormuz jurisdiction. China made no new commitment at the summit. Senate war powers restriction was rejected. Military contact confirmed as recently as May 8th. In this scenario, today's dip from $90 to 87.14 holds at the 85 to 87 support zone. The May 29th countdown continues with the vault at 80 million ounces and physical delivery demand building toward first notice day. For PSLV holders, the 86 to 87 zone is the watch level. If it holds through tomorrow's close, the thesis is intact. For SLV holders, the same support zone applies. You hold a paper instrument tracking a diplomatic headline that multiple sources confirm contains no new structural substance. For physical holders, today's 87.14 is a 3.2% discount from yesterday's 90.2. The vault has not changed. The deficit has not changed. The discount is real. The story is unchanged. For AGQ holders, elevated directional risk exists on both sides with 15 days to May 29th. Scenario 2, a formal ceasefire. The full framework is provided to members before every market-moving event. The single most important number to watch between now and May 29th is not the silver price, not the gold to silver ratio, and not the dollar index. It is the June COMEX silver open interest figure that the CME publishes each afternoon. As May 29th approaches, the number of June contracts standing for physical delivery versus rolling to July will determine if May 29th is an orderly delivery session or a delivery stress event. The registered pool is 80 million ounces. 6.5 paper ounces exist for every real ounce. When June open interest stops declining, when more contracts stand for delivery than roll away, that is the signal. A dedicated June open interest countdown video will release the moment the CME publishes data confirming delivery pressure is building. That video is the most important analysis published between now and June first delivery day. For PSLV holders, today is not a crisis. It is a test of the 86 to 87 support that has been the base of the recovery structure since mid-March. PSLV is backed by allocated metal at the Royal Canadian Mint. A handshake in a meeting room does not remove one bar from that vault. Watch 86 is the line. 3 consecutive weekly closes higher confirm the structure remains intact unless 86 breaks with volume. For SLV holders, you are tracking a paper reaction to a summit readout that multiple sources confirm contains no new substance. The support zone remains $85 to $87. Understand the distinction between what you own and what PSLV owners hold heading into May 29th. For AGQ holders, the 2 times leveraged ETF, today's $3 paper dip translates to approximately $6 in your instrument. With 15 days to May 29th and the COMEX stress index at 52 out of 100, directional risk on both sides is amplified. AGQ functions as a timing tool in this environment, not a holding vehicle. Define your level in both directions tonight. For physical silver holders, today is the simplest story. The paper market offers a 3.2% discount from yesterday's 90.2 because 2 leaders agreed on words in a conference room. The vault holds 80 million ounces. The annual deficit is 46.3 million ounces. The 5-year cumulative drawdown is 762 million ounces. None of those numbers changed today. The paper price moved, the commodity did not. Silver opened 2026 at $72.68. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.